So when we're looking at compensation, it can be any form of compensation. It is not necessarily just your paycheck, and that's what we're going to talk about today, is compensation can be in a lot of different forms. And so we're going to talk about a few of those different forms today. So mainly line 7 is where we're going to be looking at these numbers, or the numbers that are coming in. All right, so when we're looking at it, a couple of the different learning objectives that we're going to be looking at is just talking about the different forms of salary and wages, how the tax implication based on what we call equity-based compensation, we're going to talk about that. And we're going to talk about fringe benefits, which are kind of fun. We're going to talk about which ones are taxable and which ones aren't taxable. All right, so for salary and wages, when it goes on line 7, usually what we're thinking about is we're thinking about just that salary. For those of us that are salaried employees, that means that we are getting a fixed salary, $50,000, divided by, if you get paid once a month, 12, that's your salary. Hourly employees, obviously, are those that are clocking in, clocking out. You get paid for the number of hours you work in a week. And then you have things like bonuses or other supplemental pay, all going on a paycheck that's all going on line 7. How do we get those? Well, we got a W-4, which I'll flip back over here, and we're going to look at a W-4 real quick. So W-4 we all fill out when we first get employed. And, I don't know why it's still running on 7. It's confused. There we go. Nope. Be nice if there we go. All right, so W-4. So how many people remember filling this wonderful form out if you've worked? All right, so it asks you a couple questions. First, it just talks about your name, all right, your address, and then it asks about the number of allowances. Okay, so when it asks about allowances, it's asking you what do you want to claim. Now, on the second page of a W-4, it goes into a lot of detail about how you might come up with some of these, and if you have 2 income earners in a family, it has a wonderful chart about how much money might be coming out of your paycheck. I can honestly say most people don't ever look at that, right? Because what usually happens is on this front page. So the top right here goes through and it says personal allowance. So it has this little worksheet where you can go through and you work out whether or not you should take 1 allowance for yourself. If you have kids, should you take 2 allowances? If you have 2 kids, should you take 3 allowances? And based on what you fill out in A through H determines technically what you should claim as the number of allowances. Based on that number is how much taxes they take out of your paycheck. That doesn't mean it's the amount of tax you should be paying. It's the amount of tax they take out of your paycheck. So you can claim whatever you want. All right? If you're single with 4 kids, you can claim 1. Which means what? Are they going to take more tax or less tax out? More. All right? Because they don't think you need it, right? So they're going to take more tax out, meaning your paycheck is smaller. Okay? So then when you go to do your taxes, you're actually going to get money back. Because they're going to find out that you had kids, you had more deductions, you had more credits, you're actually going to probably get money back. Or you can go ahead and say, you know what, I'm taking 5, 4 kids plus me, which you can. And there's a good chance you'll either break even, you might owe a little bit, you might get money back. You might be right in there. A lot of kids right out of school or in school are going to claim 0 because they shouldn't owe any tax. Some might actually claim exempt, meaning I shouldn't have to pay tax at all. Now 0 is going to do what? Is 0 going to take out no tax, or is 0 going to take out?
It's going to take out the most.
It's going to take out the most, meaning you're going to get the most back at the end of the year. So I remember when I first started working, I actually claimed 0. Not the best tax strategy if you want to look at maximizing your income, because in the perfect tax world, you should break even in April, right? You should break even, because that means you didn't give them money and they didn't owe you money. Because if they owe me money, that means I gave them my money, which I could have been earning interest on. And if I owe them money, I'm running the risk of paying any interest to them, which is a waste of my money. So the perfect strategy is to break even. Claiming 0 isn't doing that. So if I'm single, I should claim 1. Now, where sometimes you get in trouble is with the wonderful state. All right, state doesn't always match up with the federal when you look at deductions. I can't give you a true rationale why. Okay, every state is different. Every state tax is different. For the longest time when I was single, I did 1 plus $15 because I owed every year. And I, for the life of me, could not figure out why I always owed, but I did. So I claimed 1 plus 15. And that way I didn't know. I did not want to owe. So that's what I did. So this is your W-4. Now, once we do a W-4, at the end of every year, we get our wonderful W-2. All right, now the W-2 is different from the W-4 because the W-2 is reported back to us. So I think you guys all know that, but you want to make sure you keep the difference clear. A W-4 is what we fill out when we start a job. You can change that anytime you want. And a lot of people don't feel like they can. This is not your benefits. This is not something you can only change at the time, election time, during when your company has open enrollment. You can change your W-4 anytime you want. So if you get your W-2 back, you do your taxes in April, and you find out that you are getting way too much money back. For example, when you have a kid. If you have a kid, all of a sudden you get a little bit more money back, which is good because you just spent a lot more money. But you might not want to do that, so you might go in and change your deductions. So, or all of a sudden you lost a kid. My 16-year-old now is going to not get the child tax credit, so I'm going to lose that money. So is it going to make me owe money, or am I going to still be breaking even? So you can go in anytime you want and change your W-4. Your W-2 is going to, we talked at the beginning of the semester, it's going to report our wages. Number 1 is what we're talking about right now, your wages, tips, and other compensation. And there it is. Okay, so we kind of just talked about all those wonderful forms, and then just making sure you remember the difference between the two forms. They seem very simplistic, but you want to make sure on a multiple choice you keep them separate. Okay, so what's the difference and what do employers need to consider when they're talking about salary and wages? So for the general rule is your employer can deduct your salary. All right? When you guys went through financial, if you had it, you went through and you could always do the journal entry that said salary and wages expense, and then you had something like salary and wages payable. And that salary and wages expense went on your income statement and reduced your net income, and then you paid less taxes. Okay, so under that rule, you get to deduct your wages expense. Even if you use the accrual accounting, you still got to deduct that expense. But there are some compensation where you need to be a little bit different, and we're going to talk about that. Compensation expense at the end of the year, we talked about that in accrual-based accounting also, where you have to be careful that you get paid at the end of the year. Where does that expense go? All right, so if you get paid and you worked in December, that expense needs to stay in December, even though you might pay them in January. Okay. And then the last thing on here is compensation accrued at the end of the year is deductible in the year accrued if, and it's paid to an unrelated party and paid within the last 2.5 months of the year. So that's a little bit different there. Now there is a way of figuring out what we call the after-tax expense of payroll. And this is a way of trying to figure out what are we really paying the employee, because we pay tax and the expense of tax, and we get to deduct different amounts by paying them. So if a salary is $50,000, what's it really costing me to employ that person? So it's deductible expenditure, whatever that is, times 1 minus the rate. And it's the marginal tax rate. So looking at this, we paid one of our employees, $80,000. They're in the 35% tax bracket. What is the after cost of the salary? So if we pay one person $80,000, we're trying to figure out what's the after tax cost. We would take $80,000 times 65%. So after-tax cost of that person working for us is $52,000. So taking off the tax effect, they cost us $52,000 a year. So a lot of companies like to look at that aspect. All right, the other thing we got to look at is this comes into play on the employer side. So we're not looking now at you and I preparing the tax return right here. We're looking at the employer implications. And there's something called the $1 million maximum. Hasn't hit me yet, okay? But the $1 million maximum is you cannot deduct compensation to a single employee that exceeds $1 million. So what this is limited, it applies to CEO and the 3 other highest employees for your company. Not the CFO, which I can't tell you why, but not the CFO. So the CEO and the 3 highest compensated officers. It does not include what's called compensation-based, and we'll talk about that in a second. So when we're looking at what's considered, before we even get to the $100 million maximum, we look at what's considered reasonable. And we talked about this a little bit before, that for example, if the normal job to run a restaurant, a manager of a restaurant, is $45,000, but I open a restaurant and I'm paying my brother to manage it, and I'm paying him $60,000, I cannot deduct $60,000 as my expense because it's not what's considered a reasonable payment for that job. I'm paying my brother more, probably because he's my brother. So when you're looking at deciding whether or not it has to meet what they consider the reasonable test and what they call facts and circumstance. Would this be what everybody else would pay someone to work? All right. Is the amount of salary compared with the income of others? Complexity in the business. Consider the duties. What are they doing? What is my brother doing that's worth $15,000 more than everybody else besides the fact that he's my brother? Nothing. Okay. He's probably doing $15,000 less than everybody else. All right. So you cannot deduct that. So what do you think when we're looking at these compensation of a maximum, what do I mean by performance-based? What is performance-based? So we just said you can't deduct more than $1 million. So does that mean that when Trump, and I'm using him because right now he's everywhere, so it just came to my head. When Trump was working, before he became, well, he's still not, but before he starts being president, did he pay himself less than $1 million a year in compensation for his job?
Probably not.
Probably not. I don't know that for a fact, but I'm just going to go with no. No. Did he pay his daughter, Ivanka, who ran many of his businesses, less than $1 million a year? Probably not. So just because that's the maximum compensation deduction does not mean companies don't pay people more than that. If they choose to pay someone $2 million, they get to deduct $1 million. They just don't get to deduct that other compensation. And we're going to show an example of what happens. But sometimes they do $1 million salary and then they pay with performance-based. What does it sound like performance-based is?
Like you get goals or bonuses if they sell.
Yes, you get goals or performance-based. You have to set certain expectations. So a lot of times when I hear performance-based, I think of athletes. They get bonuses a lot of times based on how they perform. So football is the one that jumps to my mind the easiest. If you, a running back exceeds so many yards in a season, they get a bonus. If a quarterback throws for so many yards in a season, they get a bonus. I'm sure defensive people have something in there too. They get so many tackles or whatever. I'm sure baseball has something. I'm not sure what it would be. So many hits, so many pitches, so many strikeouts. There's things in there, and they're used as incentives. All right? In teaching, I don't have a performance-based thing. There's a lot of people, though, and I laugh when I say that. There are some people, and in Missouri too, that think teaching should be performance-based. You get paid based on how you teach. The problem with that is, who's going to evaluate it? Because do you think that everyone's going to strictly evaluate someone teaching in the classroom based on what? When you tell a running back they have to run 1,000 yards, can you do that? Can you fairly judge if someone runs 10,000 yards? Yeah. Can you fairly judge in a year how well someone teaches? Depends on the student, right? Because if half this class gets Fs, is it because they stopped coming? Or is it because I didn't teach good? And did they stop coming because I wasn't teaching good? Or did they stop coming because they stopped coming? Which also happens, right? All right. And so, did you not like me because I was bad? Or did you not like me because I wouldn't give you an A? So all those things, you can go out to rate my professor. I don't mind it right now because I'm doing fine. But if I started being meaner, maybe I wouldn't do fine, right? We had a professor, I'm not going to say what department, who is no longer with us, who every semester was in a department where classes filled up. I don't know if they still do, but classes filled up all the time. But by the middle of the semester, his classes went from full as 30, okay? Not every department, but full as 30. They were 30, and by the withdrawal date, they were down to 15, and sometimes he ended up with 5. So that, to me, is a little easier to read, okay? But other than that, to me, it's very hard. And let's go down to the elementary school, and the middle school, and the high school. Is it performance because the teacher can't reach a student? How do you judge that? So that's been the big argument when you look at performance-based in teaching. And performance-based in accounting, how would you judge it? You work for a public accounting firm. What if you got a boss that doesn't like you? But it is slightly performance-based, though, if you think about it. When I was in public accounting, I had a salary, but my bonus was based basically off if my boss liked me. And if he thought I did a good job, right? Because that's who I worked for. And that's some of the argument behind teaching, is all the other careers out there, you get bonuses based on how well your superiors think you did. So they kind of go back and forth on performance-based. So performance-based can be very specific, and it can be very generic. And my brother works for a company where they do a lot of bonuses. And I laugh sometimes at how the bonuses are kind of put out there. But they are a fantastic company to work for. But I will tell you, they also have no problem walking up and saying, you know what? You haven't talked for 2 weeks, you're fired. And they're gone. Just gone, and you're done. They have no problem.
What company is that?
Huh?
What company is that?
I'm not going to say the name now. Okay. But they are, but a very good company. But they have 2 partners. It's a partnership. They have 2 partners, and one of them is very outgoing, talks, and would never do that. And the other one isn't quite as outgoing, but he has a reason. And his philosophy is, if he hasn't heard from you in 2 weeks, what are you doing? I don't necessarily disagree, but at the same time, I take a little different tact than that. But, some of it's just a little bit. So, everybody has a little bit different. So when you look at compensation-based, it gets a little sticky sometimes. But the reason I kind of spent a little bit more time on it is because, I don't know what I just did. There we go. Is because if you go and you're looking for jobs, a lot of time compensation-based sounds awesome. Performance-based sounds awesome. Because you think to yourself, I'm going to do great. And a lot of times, you're going to do fantastic. But you just got to think about that downside. And I don't like to take risks. So that kind of puts me in the chicken mode about compensation-based. Because I was talking to my brother, and I'm like, he was talking about doing something. I can't remember what it was. And I'm like, well, yeah, but a lot of your salary is performance-based. And he goes, yeah. And I'm like, what happens if you don't get that? I think he was going to do a 15-year loan on his house instead of 30. What happens if you don't get that big chunk? I said, are you going to still be able to make a house payment on a 15-year loan if you lose half your salary because you didn't make that goal? He goes, ooh, that's a good point. I can't live like that. That would freak me out. I need to know that I can live on my salary. But I'm also a chicken, so you got to kind of take that into account. Okay, so talking a little bit about this, the next part, if I would have switched on to the next slide for you guys, which I didn't, but I'm going to now, or maybe I'm not, because it's not letting me. Hang on. There we go.
So
Okay.
the performance-based, are you still capped at the $1 million
No.
deduction?
You're capped at $1 million salary. Performance-based is not salary. It's based on how well you do, because you could get 0, or you could get $10 million. You could get $20,000, you know, if you're a normal person. You can get $3,000, $5,000, $20,000, or if you're an athlete, you could get $5 million. So that's not capped.
It's deductible?
It's deductible. Performance-based is deductible. Yep. And that's why a lot of companies do that. They give, okay, here's your $1 million,
Ah, then I get it.
and here's your performance-based. Exactly. Exactly. But at the same time, some companies don't care. And they'll say, here's your salary. Okay, so this is a little bit, this went off of the beginning of the chapter. You know, they always give a little story about somebody. We don't really need to know the beginning of it, because it was just a little bit about this girl who started a new job. And she was trying to decide if she should take the job. Part of the job offer, Julia found out, was that following her acceptance, she would be granted 10,000 shares of restricted stock, 50 incentive stock options, which are called ISOs, 200 non-qualified options, which are called NQOs, and each stock option gives her the right to purchase 100 shares of stock. 50 ISOs allow up to 5,000 shares, and 200 NQOs allow up to 20,000 shares at a fixed price. And as she read on, she realized, and it goes on and on and on, and talked about the grant date and everything else. So this was another form of compensation. Her salary was X amount, and then as part of her salary, or part of her compensation package, she was not only given her salary, she was given that after her first day in January, she would be given these stock options. So stock options are not a salary. Stock options are something that you'll be given in the future that may or may not pan out to be anything. Because if you look at here, it says she'll be granted these things. 10,000 shares of stock, restricted stock. 50 incentive and 200 qualifying, non-qualifying, sorry. So when you go in and you look, they are exercised at a stated price, which 2 years from the grant date. And then she understood that they are restricted stock vest 1 year after the grant date, and then she'd be free to do whatever she wanted. But she also saw that they expire 10 years. So she has a time frame that she can exercise them, which means she can do something with them. But right off the beginning, she can't. And that's what happens with most stock options. You're given the option, but you can't do anything with it. You have to sit there and watch it. Then once that date passed, they vest, you get to exercise them. And you have a period, sometimes it's a year, sometimes it's 8 years, in which you can do something with it at that grant price. And then they'll expire. And you got to decide, do you want to exercise them? Do you want to buy them? Do you want to benefit from them? Can you benefit? Can you afford to benefit from them? And then do you? So they are a compensation, but sometimes you got to make sure you have the money to exercise them, to take advantage of them. So I'm going to flip to the next page real quick before we go back in to the slides. And this just gives, and this is on the next page, but this just gives, on page 12:9, just a little pictorial of how the options in this example worked for her. Okay? So she received the stock option grant on January 1st. The shares traded at $5. All right? Then she can exercise the vesting options on January 1st, year 3, if she chose to. So they had a 2-year vesting period. They're now trading at $15. And then it says she exercised all of her options on December 31st of year 3. So basically 3 years went by. They're trading at $20. So they're trading at $20. She gets to buy them at $5. So technically, she's making $15 a share. Then she sells all of her shares at the end of year 5 for $25. So she made $20 a share. She held them for only 2 years. It's long term, so she's going to get the tax benefit. And then Julie's options now have expired once we hit the end of year 10. And that only means that if she hadn't used them, they'd be gone. So in this instance, she was able to benefit from them quite a bit. She had $20 a share that she was able to get from them. So let's look at the details behind these stocks, because there are a difference between them. So incentive stock options are favorable to you and I. These are the ones that if we're given them, we have the better tax advantage. And I'm going to tell you why, because NQOs are coming up. But this is the only kind I've ever gotten. Right, these I was given a lot. AT&T gave these out a lot when I worked for them. I don't think they do that anymore, okay? Just from my few friends that are still there, and actually the ones that were there after I left, they really stopped doing this. But these can be very, very lucrative, and they don't have to be near as many as what they just showed us there. I mean, they used to give us like 40 or 80, you know, and it was just one of those things where AT&T had a great year. So every employee gets 40 shares. It was January 1st. You can start exercising them. You can buy them at $42, an example. You can start buying them July 1st. You can exercise them for the next 3 years, and then they expire. And there was a very short term because they gave them out quite a bit whenever AT&T, it wasn't like our goal, it was more AT&T goal. So when AT&T, and I wasn't AT&T, I was actually Southwestern Bell, but when Southwestern Bell hit that goal, we got the shares. And so we hit it several times when I worked there, and so we had several different stock options. And the other thing AT&T did to help their employees is they worked with Merrill Lynch to do what we call a buy-sell. And Merrill Lynch helped us that if we wanted to buy the stock just to turn around and sell it, they front-loaded the money. So, for example, when I did one of the stock options, I was watching it, and this was the only one that I made a lot of money on, and I say, not like she just did, okay? But we watched it, and it was right before I got married. And so we kept watching the stock, and we did buy it at 42. Watched it, it was up in the 60s. I kept watching it, call my mom, call my aunt, I don't know when to sell it. My husband now and I were watching it, and we're like, okay, when it gets to 70, I'm going to sell, because I needed that money for our wedding. And so we watched it, and so we called Merrill Lynch, and we put in what was called a sell order. Because during the day, if you ever watch stock market, it can go to 70 for 1 second, and it could drop back down to 69 point blah, blah, blah. So I put in an order to sell at 70, and as soon as it hit 70, Merrill Lynch would buy it and sell it. So I didn't actually have to spend any of my money. And I don't remember how many shares it was, but whatever number of shares I had, they bought it at my $42. I got to buy it at 42, and I sold it at 70. So they were able to do that all electronically, all very fast, and I didn't have to give them any money. So that was even another perk that AT&T gave to their employees. So not only did we have these ISOs, but they contracted with the firm that allowed us to do that money. Now, I could have also just bought them. And I could have hung on to them, and they'd be not worth any money right now because AT&T's trading at like 38. So, and after I left, there were still more options, and I remember some of my friends that sat on them, and they became worthless. So stock options are great, but like that lady, Julie, hers were good for 10 years. You hang on to them for 10 years, they might not be any good. So they can be a great compensation, but if you hang on to them for too long and the company goes down, you just lost your bonus. So it's a waiting game. I was even nervous. Now, AT&T only hit 72. So I did sell at a good time, and then they split. So I did sell at a decent time. I didn't like start second guessing myself, saying, oh, they went to 80. I did sell at a good time. So the non-qualified options, okay, those don't meet the requirements for being classified as ISOs. The grant date is when we get it. The exercise date is when we purchase it. Exercise price is the price that we buy it at. Okay, the bargain element is the difference between the fair market value and the amount that we pay on the exercise date. So what is it worth versus what we paid? So obviously my stock was worth 70, and I paid 42. All right, 28 bucks, right. And that was my gain, if I look at it like that. Minus, I think I had to pay like a $40-some fee to Merrill Lynch. All right, vesting is the time when the stocks are granted between when they're granted and when I can exercise them. Mine was 6 months. The example before that, Julia, hers was 2 years. It can be whatever the company wants. Okay, employee consideration for stock options. NQOs are different. And when you are given an NQ, a non-qualified stock option, you actually have to report ordinary income equal to your bargain element when the shares of stock are acquired. So that's different than ISO. So when I would have bought that stock at 42, if I would have held on to it, I wouldn't have had to do anything. I just bought it. But if it was an NQO, as soon as I bought that stock, I would have had to report it as ordinary income. So employers like NQOs. The tax advantages for them. The ISOs, the tax advantages for us, because I don't have to show any tax implications on an ISO until I sell. When I buy it, I just buy it. I don't have to show any gain or anything until. Now, I did have to show a gain when I bought that stock because I sold it at a gain.
So in your case, there was no difference between this one or the ISO? Because
No, there is a
on the
tax.
same day.
No, the NQO there is. Oh, when the way I did it? The way I did it, no. You're right, because I bought and sold on the same day. Right. Okay, taxpayers, okay, required a fair market value, and the basis is the exercise price. All right. And the ordinary income that you paid. The basis is the exercise price plus the ordinary income that you recognize on that day. So incentive stock options, we already talked about. So for either type, employees experience no tax until we actually, either the grant date or the vesting date. It's when we actually exercise them. So nothing on the grant date, nothing on the vesting date, but when we actually exercise them with NQOs, and then when we sell them for both ISOs and NQOs. Okay, so NQOs, no tax consequence on the grant date. So, but on the exercise date, the bargain element is treated as ordinary income. So you got to go out there, and as soon as you buy it, it's ordinary income. It's compensation. It goes on line 7. You guys don't like to put it on line 7. Okay, you like to go down and put it as other income. Because for whatever reason, it doesn't translate in your head as wages. You see line 7, and you see wages and salary. And then you see stock options, and you put it down line 21. And when I'm grading the old tax project, I see that you got it, and I can't even remember the number from the old tax project. It was like 21,000. I see it down there, and it actually might be on your practice problem too. I can't remember. I see it down there on line 21, and I'm like, okay, they got it right. But they put it in the wrong spot. And you lose a point. But on the new tax problem, if you put it in the wrong spot, it's going to yell at you, okay? It's going to turn red. So you want to know that stock options go on line 7. Stock options are compensation. They're given to you by your employer. They're not other income. They're not, oh, this is fun, okay? They're given to you as compensation. And it may or may not be on that practice problem. Did anybody get that far? I think I gave you stock options on that practice problem. If I did, I just helped you. Okay, so there we go. Employees can hold it for as long as they want, and then they deduct the bargain element on the exercise date. I already mentioned there's no tax consequence for ISOs. It's a long-term gain no matter what. They're long-term gains. And then employers don't view them as tax favorable. I already went through all that. All right, and then accounting issues. For tax purposes, employers deduct the bargain element on the exercise date. So if you're the company, you're going to deduct that. For GAAP purposes, employer expense, they estimate the value of the option and they prorate it, all right, over the vesting. Why do you think, and this is just a little bit different, but if you can think back to GAAP, why do you think the employee expense is prorated over the life of the vesting period? What do we try to do with GAAP? When you're looking at GAAP, why would they take an expense and prorate it over the vesting period? What are they trying to do? Am I taking you too far back?
Just trying to spread out the expense.
They're trying to spread out over the expense over the vesting. Now, honestly, we don't know how long it's going to be there, right? I mean, you could sit on your options for 10 years, but the vesting period is the only time frame that we know we're definitely going to have that stock. So that's the period they spread it over. Okay, so here's the first example. So take a second. Mary is offered 7,000 options. I was not given that many, okay? 7,000 options, that would have paid for a really, really nice wedding. 7,000 options on January 1st, 2012. They vest 3 years later on 2015. The exercise price is $10 a share. So then on January 1st, 2015, she exercises all of them when the price is $17. She held the stock for 2 years and she sells it for $20. She is 30% tax bracket. What is her tax liability on grant date, exercise date, and sale date? So first, treat it as an ISO. That's what I told you I had. Think in your head, what is going to be her tax liability on the grant date? What about the exercise date? And what about the sale date? So first, what's going on the grant date? Zero. Because on the grant date, nothing's happened, right? Have I gotten anything? No. Do I have to get anything? No. What about on the exercise date? Have I gotten anything? Not necessarily, right? Because I haven't bought anything. I could, but I haven't. All right, what about the sale? And if so, what? How would I figure it out?
Well, the sale would be, she'd be paying taxes on the difference between what she bought it at and what she sold it at, right?
Okay, and so what is that?
Be $10 a share.
$10 a share times 7,000 options. So that's 70,000. And is it times the 30%? No, times what?
Top total, 15.
15. Right. She's in the 30% tax bracket, but it's going to be a 15% thing. So she's going to pay $10,500 in taxes. Right. So I got to tell you something.
I thought you said that was part of wages, though, and not.
But in the end, your tax liability is going to be 15%. There is no 30% tax bracket. This just cracks me up because you'll see this when you're doing people's taxes. So you will hear people say, I had to pay $10,000, so it's not even worth getting them. You'll hear people say that. It's kind of like when someone gets a raise. I got a raise, I got a $50,000 raise, and now I got to pay $10,000 in taxes, so the raise isn't even worth it. You're like, okay, you just got a $50,000 raise, and you got to pay $10,000 in taxes. That means you netted for $40,000. You just netted 60 grand. You're fine. But they get upset because they have. What happens is, do they pay that $10,000 when they got the 70? Not usually. When do they owe and pay this $10,000?
When they file their taxes.
When they file their taxes. So, on a tax return, where they normally break even or get a couple $1,000s back, maybe if they're lucky, now they owe 10 grand. That's when they get upset. Because now they didn't realize they were going to owe 10. That's what usually happens. People don't realize that they're going to owe tax on $70,000 because they weren't told that. They were told you can, the very first time, they get it after that. They weren't told that they were going to have to pay tax on the $70,000, and they don't think about that. So the first time around, it gets them very mad.
Don't you usually, when you sell that, though, don't you usually have the option of them withholding the
You can,
tax on it?
yeah. People don't do it. You can, and I would. I withhold on. I withhold on anything. But you know, it's also like people who take out cash in a 401k. I can't tell you how many people that I hope do their taxes who like switch companies or whatever, and they end up taking some of their 401k out or whatever, and they talk to their advisor, and they tell them, you're going to have to pay a penalty for early withdrawal. So they say, okay. That's the only tax they think about. Or they don't tell them about the penalty. One of the two things happen. So what happens is not only do they pay okay, so they'd say, okay, well, I took out 20% tax. Well, you took out $70,000. That's a $7,000 penalty for early withdrawal. And that $70,000 just puts you in a different tax bracket, and you just lost all your credits. No child tax credit, no dependent care credit, no college credits. You just lost all your credits. So you lost like $4,000 in credits. You jumped a tax bracket. You owe $7,000 in a penalty. That's why you owe $10,000 in tax. And they get upset because their tax, it's not a tax advisor they talk to, it was a financial advisor. And most financial advisors don't ever think about jumping tax brackets. And that's a lot of times if it's more than a couple $1,000s, you do that. Okay, so the NQO, is that going to be the same? No. So what about the grant date? Do we have any tax liability on the grant date? That one is still 0. What about the exercise date? 7?
Yes.
Just $7? How much? $7? We do have to recognize something, you're right. We have 7,000 shares at $10 a share. So we have to recognize 7D. All right? But do we take, what about the tax liability? What percent do we recognize that at? Huh?
Yeah.
30, right. So 7,000 times 30%. And then what about the date of sale?
And you got another 70,000.
Another 70? We already did.
Because now you're, I mean, it's the same,
Another 10, another 7? Okay, now let me ask you this. The exercise price is 10. On the date when they all become available, the price per share is 17.
So the base is 17.
Okay. Right. Now, when we did the other one, what did we do on the date of sale? We took 7,000 times 10. All right? We're not going to use 17. We're going to use 7. The difference between the exercise price and when we vest and the market price. $7. That's how much it's gone up. So on the date that we could exercise them, it's 7,000 times 7. And then it is at 30%, just like you said, because that's how much it's gone up. We could buy it at 10. It's selling at 17. So we have an increase of 7 at the 30%. Then when we actually sell it, we take the difference. Now it's selling at 20. We only have to do the $3. But notice the difference. Now we're at 17,850 in taxes. 17,850. If I go back a slide, we're at 10,500. That's a big difference between the two. That's why we like this one versus this one. The same number of shares, but it's the way they're granted. So an ISO, we pay $10,500 in taxes. An NQO, we pay $17,850 in taxes. It's a big difference. Now we pay them at different times, but we still pay more. So the difference is you take the bargain purchase price, so at the exercise date, how much more is it from the grant price? And that's at the 30%. And then how much more did it go up when we sold it? And then that's at our tax rate. So the big difference here is this. Right there. All right, and then we have something called restricted stock. Restricted stock basically says you can't sell it. Otherwise, you can treat it as being owned, but you cannot sell it. You don't have the legal rights to do different things with it. That's restricted. Employees can receive it throughout the whole vesting period. You don't have to pay for it necessarily, but you can't sell it. And so if you remember from the beginning of the story, she received, I can't remember, a lot of shares of that restricted stock. She got 10,000 shares of restricted stock. All right? She didn't have to pay for it, but after it's not restricted, she can sell it. But right now, she can't do that. Restricted stock are fully taxed at the full market price on the date the restricted stock vests. So once she owns it, that's when she pays for it. Because at that point, she owns it. She doesn't have to buy it. She owns it. And so that's actually not a bad way to get stock either, but you do pay for it at that point because it's your stock. And actually, that's not how I was given it, but when I was at AT&T, they also gave stock away. That was even better. But you did, that was compensation. There were 3 years in a row, I think, where they gave 40 shares of stock, just as a gift. Might not have been 40 shares, but it was roughly that amount, where it was kind of nice. You're just kind of like, here's shares of stock. I mean, I own, I don't even know, 300, 400 shares of AT&T stock, and I didn't buy any of them. Now, I also take my dividends and I reinvest them as I go. And that doesn't seem like a lot when you're getting 8 dividends a year or 12 dividends a year. But when you keep putting those dividends in, and it adds to the number of shares you have, every year I get more dividends because every year I put them back in. But I never bought 1 share of stock. So what's going to happen when I sell that stock?
You pay tax on the full amount.
I'm going to pay tax on the full amount. And that's okay. I won't like it when I do it, okay? But I know in the back of my head that my basis in that stock is 0. And that hopefully will be there someday when I retire. But it's also our, oh my God, we need money fund. So that's there. We don't ever want to touch it. But in the case that my son can't figure out how to drive because he's on his 3rd car accident, well, yeah, I know. I don't. And they're not even like bad car accidents because he's out driving recklessly. They're just dumb. They're just like, I told him, I said, is your head in the clouds or are you just a bad driver? I just don't know which one it is.
Or do you pay attention to your cell phone?
No, I check that every time. He has not been on his phone, not one of the 3 times. The last time he was following me. I saw it happen. It was horrible.
Uh-oh.
He followed me. And he admitted afterwards. He said, I didn't even look. There was a left turn flashing yellow. And as soon as I turned, I'm like, oh my God, he's going to follow me. I knew it. As soon as I turned, I knew he was going to follow me. And he followed me, and I heard it, and I looked because I was waiting to see how bad. And he kept going. The other car stopped, but I mean, and he said when we got home, I said, my husband's like, did you even look at the light? And he's like, no, I just followed Mom. Because it was a flashing yellow, and he just kind of assumed it was green. I went. His head's in the clouds. And now his head's not driving a car. So,
That's probably for the best.
yep, nope, he gets to be driven places for a while. So, but,
Ouch.
yeah, it's killing all of us, though, is one of the problems, because obviously,
We have free post food.
there we go, huh?
We have free post food.
Yeah, no kidding. It'd be nice if the bus came by our house in the morning to take him to school. He's riding the bus to school, though. It's not the way he likes to go, but I'm like, guess what? Yeah, exactly. Stop wrecking my car. And this one had to go to insurance. The other 2 didn't go, but this one was. So now he has to pay that. We already told him if insurance goes up, you got to pay that. So it's $22 a month, which isn't horrible, but. Okay. Anyways, so did I go to? I think I went. Okay, yes, I went too far. Okay, restricted stock. So now we got to talk about 2 different types of restricted stock, and then we're going to work a problem. So there are 2 different types we got to talk about. It's with 83B and without 83B election. Okay, so without 83B, there's no tax consequence at the grant date, meaning nothing happens. You grant the stock, nothing happens. Employees recognize ordinary income on the vesting day, but nothing on the grant date. The holding period starts when you vest, meaning you don't do anything until the vesting day happens. And the employee deducts value of the stock on the vesting day. The employer, sorry. So the employer doesn't do anything to it vest. We don't do anything to it vest. Nothing happens without the 83B election. With the 83B election, on the grant date, we recognize the stock at the market value. So the date it's granted, for example, my AT&T stock, the date it was granted, it was trading at 42. So I would recognize the value of that stock, $42, let's say 100 shares because the math's easier, okay, at $4,200. It was not 100 shares, but let's say it was 100 shares. $4,200 I would recognize as ordinary income. Line 7, wages. That's how much I'd put in there. The employee we take the fair market value, the holding period starts, all right, so whatever I have to hold it till before I can sell it. If it never vests, we don't take a deduction. And then the employee deducts the value of the stock on the grant date, employer. So my employer, AT&T, deducts it the day it grants. We put it on ours on the day of grant. So they take it off, we put it on. So the timing of the deduction determines whether or not it's 83B or not. So there are other non-factors you got to think about. The employer deducts the market value when we recognize the income. So the employer deducts it, they recognize or deduct the market value when we recognize the income. The two have to go together. And then for GAAP purposes, the employers deduct the grant value, again, over the vesting period. They do it over that time frame. Okay, so James receives 4,000 shares of restricted stock on June 1st, 2014. When the stock was valued at $3 per share, the shares vested on June 1st when their values were at $8. He sells the shares when they vest. He's in 30% tax bracket. What's his tax liability on the grant date and on the vesting date? So let's assume he does not make the 83B. He does not make the 83B. So on the grant date, what is his tax liability? What did we say about not making 83B? Zero, right? So there's nothing on the grant date. What about on the vesting date? How many shares did he have? Do the easy part. 4,000. So on the vesting date, we would take 4,000 times. No. We've done nothing so far. We've recorded nothing. So if we've done nothing, what amount are we going to have to put it at? 8. We've done nothing, so we have to put it at the full $8. 4,000 times 8, and then what tax are we going to be looking at? 30. Right? 4,000 times 8 times 30. Now I can't flip the slide because the other one's on the same slide. So what about 83B election? What's the tax liability on the grant date?
12,000.
12,000. So we take now. So it's $3 a share times 4. That's correct. What about the tax liability? So we also have to multiply it by 0.3. Right. Okay. And then what is the tax liability on the vesting date?
That would be the gain, right? The
It-
$5.
$5 times 4, right? And then this time times 15, right? All right, so the difference, again, here we're looking at $6,600 in taxes. Here we're looking at 96. So which one do we like now? Do we prefer the 83B election? Which one are we paying more tax on? We're paying more tax on if the 83B election is not made. Right? So we actually like the 83B election.
I just have a question. Why
Yeah.
we gonna pay 15% instead of 30?
Because at that,
Gains.
thank you.
But it's just 365 days, so just check the days.
But we did the $3 a share as income, and now we're selling it at
June
the.
1st and June 1st, just because I'm.
Well, actually,
it's a year and
that's a
day.
new year. Yeah,
Uh-huh.
it's a new year.
Okay.
But
So
what?
it's not a year and a day to get a capital gain.
That is a year and a day. It's 364 plus 1. But what were you going ahead and saying? No. Yeah.
Oh,
were you
I
saying?
was on a different,
But I think you were right. What were you saying?
that the $5 a share is capital gains, which is why it's at the 15%.
At 15%, because we already took into account the fact that we took it
Yeah, we
first
already did
at
the
the
$3.
$3, and that's what we recorded the actual asset at, and then we had a gain of $5. The other one, recording at not 83, recorded the whole amount.
Okay.
I know, the tax there is tricky on both of them, I think, and you guys actually done very good at the 30 versus 15. So, but it is tricky trying to figure out which way that goes. So here's a little, I'm not sure, I actually went back and forth on whether to even include this slide. So, a little equity-based compensation. just kind of NQOs versus ISOs and restricted stock. Your grant date equals a year, and it talks about who's affected and who's not affected. Basically, you can see the grant date and the stock price, that affects only the employee. The employee is affected by the grant date equals a year. The stock price, exercise price, is the employer. The vesting period affects the party, and then obviously the restricted price is ordinary income. It goes through, this example matches up perfectly in the book if you want to take a look at it. But it just talks about how it matches up for the example. But some of it's helpful, some of it I think gets a little confusing. It just depends on how you followed that example. All right, so before we get into fringe benefits, let's take a look